Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from TikToker. Let's jump right into the board here and take a look at the metals here. Silver is up 43 cents, 26.34. Last gold is trading at 1731.80, up about $12. Let's take a look at the charts here for a minute, just to get an idea of where we are for today's signals. I want to jump right into the market and take a look and see what the VCPMI is recommending for us for day trading. And we'll take a look at the weekly numbers as well. What you see on the left of the chart is the daily numbers. And we're looking at the sell one level at 26.36 for silver. 26.70 is the sell to level, and we're trading at 26.31.50. So we've completed the first silver target of 26.36. It has taken three bars to complete the pattern. Now, when we get here at the sell one level and it turns into red color, it basically, this is the AI, the algorithm, identifying the first level of basically a high probability where the market may reverse if a trigger point is activated. Now, the AI tells you that on this bar, on this completion of the price reaching the target of 26.36, it's completed the first objective of the bullish trend momentum, identifying the highest probability area. So we're looking at 26.36, 26.70 as what the AI begins to identify as a high probability area of distribution of supply, or based on standard general conventional wisdom, it is called the first level of resistance. The AI goes a little more in telling you that not only this is the first level of resistance, but it is a mathematical probability that the price is at a 90% probability. It's a 50-90% relative to the implied volatility of the mean. The mean is the average price, and it's a 50-50 standard deviation. So the sell one level is a 50-90% standard deviation to the mean, and it's a 1-to-1 factor. So it's the first level of the extreme above the mean. And so on this bar, basically, it's identified a short trigger by the market closing below 26.36. And we're going to take a shot and selling short one contract from this level here. And if you are basically following this, you can choose to use it. I'm using the Thinkorswim platform here, which is a simulated platform. But for you, if you want to execute this on a real-time basis in your account, it's up to you, depending upon how you manage your risk. What I'm doing here is I'm showing you how I personally am executing this information and how I identify the signals basically that are produced by the VCPMI. We have activated a short trigger in silver on a close below 26.36. The gold market has not yet completed the target of 1737, and it's trading between the average of daily average of 1717 to 1737. So the one that has activated the short trigger is actually the gold market. The silver market actually has activated the short trigger. And the gold market has not yet completed the target of 1737. If you follow the trade, I would suggest if you do it multiples on the first contract, if you made $125 to take profits, it's the objective to take the profits as quickly as possible, particularly if you're doing one contract. And in this case, I just did one contract and I locked in here $350. If you follow the signal, it's up to you, depending on how many contracts. You can choose to get out of the position, or if you want to follow the position, use a trail stop to your entry point. And the objective would be 25.89. I wanted to show you here the practicality of execution on a short-term basis for day trading, where you can realize an immediate $350 profit right away. And as far as I'm concerned, if I can make $300 in a matter of minutes, that's a pretty good average. If you can do this consistently and systematically, over a period of time. So the way that I come in here every morning, and as I'm coaching and teaching you, basically I am trading these signals and executing the signals. The way that I manage the risk obviously is different. What I have found out is that every trader is completely different than everybody else. So not every trader is homogeneous. So you want to use this tool based upon your profile, based upon the size of your account, based upon your risk tolerance, your profile for risk, and your money management. In terms of how you position yourself. What I'm doing here is I'm showing you a tool that I'm using for directional signal in the market. And obviously how you apply that intelligence is up to your skills as a trader, and also up to basically your profile. in terms of, again, risk and money management. So coming back here to the signal, we've locked in the first trade of $350, and now we're neutral. And we can take a look at some of the other markets and see how the rest of our position is weathering, you might say, in today's markets. We have a pretty strong day for the precious metals sector. Gold is up $10, silver 37. So all the derivatives underneath, which are thousands, are up as well. I'm just cleaning up here the board a little bit, and I want to get into a little more on what we're looking at in terms of the weekly numbers. What you can see here is that the high so far in gold has been 1733. And the sale one level is 1737. So we didn't quite get up to that sale one level in gold yet. The silver, the high was 2639. And the sale one level was 2636. So we have completed the first target in silver. Copper is trading at 414. The sell one level is 418.78, and we've made a high of 419. So the copper has also completed the first target for today. The mini S&P is trading at 39.32. The high is 39.47.75, and the sell one level is 39.47.42. So you can see the accuracy of the signals in different instruments that can be used for. It's a universal trading tool that you can apply to just about any instrument. We choose to use the most liquid instruments, obviously, like gold, silver, the mini S&P, Bitcoin, and we use the Grayscale Bitcoin Investment Trust to trade Bitcoin, which is a regulated instrument. It's the first ETF for Bitcoin that is used, and it's a very effective trading tool in following Bitcoin. If you want to be independent of all of that technology, you might say, of all of that wallet technology that you need in order to trade the cash in Bitcoin. And I think between this, as a trader myself, in terms of trading, 3 or 4 instruments is pretty much what I feel comfortable in terms of selecting a sector in the market, which is what I suggest. And within that sector, if you want to expand, you might say, your application of the VCPMI a little more, into the different time frames, then you can use the weekly and the monthly time frames for you to trade, for you to swing on a weekly basis, and also for you to take, position trades. You might say that could last, more than a month or a month. For longer term traders, obviously, we recommend to use the annual numbers and the cyclical numbers. So depending upon how you want to organize your portfolio, you can expand this trading tool to accommodate those goals and objectives that you have. And that is whether you're a home office, whether you're a pension fund, whether you're an individual trader or retail trader. This is a very, very effective tool in customizing it to the markets that you want to trade. So for myself, as I said, within that sector that we're looking at in metals, for example, we have other derivatives that are underneath, like nugget, for example, that we trade in order to manage the margin risk that a futures contract would give you on an overnight position. And these are aggressive instruments, they're ETNs. They have a small time decay, but I do not recommend for you to hold these instruments for long term. These are tradable instruments in to a certain degree. I'm talking to active traders right now that are looking to day trade the market. You want to expand, I think, a little bit into taking a look at some of this 2-to-1 factor, 2-to-1 velocity ETNs that really are based upon either the futures contract volatility or the underlying ETF that is pretty much the major ETF of which this instrument is based upon as a derivative. Excuse me. So depending upon how you manage your risk, you can choose to position yourself in a way that you can benefit by the market as a whole in a macro picture than just, you might say, day trading the market. What I would like to do here is I would like to take a look at the weekly numbers that we published in Seeking Alpha in Marketplace. This information is published by Saturday. It's a prospective view of the markets as we come into this week. And if we take a look at the gold weekly report, we came in with a weekly trend momentum of 1783, which is bearish. This is the first filter that we use in writing this report, which is a little more expansive than the trading information that we provide in our website, in our live trading room. This is the first filter, which is the 9-week moving average of 1783. And because the market closed below it, we're coming in this week with a bearish trend momentum. The weekly VCPMI, which is the variable changing price momentum indicator of 1712, is bullish. Now, the market closed above the average price. This is the mean that we have as we come into this week. So we have a little bit of a kind of conflicting signal here in that the weekly average as we come into this week is bullish, but the trend momentum is bearish unless we close above 1783. Closing above 1783 completely turns the trend, the long-term trend of gold, to a bullish trend momentum. So that is a number that we want to maintain and we want to watch for the rest of this week. The algorithm gives you also a stop, and it tells you that even though the VCPMI or the market is trading above the average of 1712 and we are bullish, then you can use the 1712 stop as a protective level to protect this position. Because by closing below 1712, it's going to negate this bullishness to neutral. And if we get another close below it, then it activates the bearish price trend momentum. And the targets of 1687 to 1648 are activated. Because we're trading right now at, let's take a look at gold here. 1728.50. The weekly target is 1751. So we have a little bit of ways to go there. So we have a bullish trend momentum by the market trading above 1712 and has activated the targets for this week of 1751 to 1777. And the sell-to level weekly is pretty much very close to 1783. So if we get a close above 1777, 1783, 1783, the market will be breaking out of this pattern, and even will include the monthly of 1781. So that above 1780, I would say to you, for you fellows that are holding long in the gold market, would validate at that point the fact that the lows at 1673 have been completed. That's the confirmation that we want to see. So in the meantime, we have shorter term targets here that we want to accomplish. Now, as you can see here, a little more clearly, we have broken down the filters that we use. And as I said, the first filter is the weekly trend momentum at 1783, which is bearish because the price closed below, and it pretty much activates a bearish trend. But it also gives you a very clear alternate count that if the market does close above the 9-day moving average, it negates this bearish sentiment that we're looking at. Again, here, this is the second filter that we use, which is the mean or the average price. And with the market closing above the average price, it activates, or it tells us coming into this week that it is a bullish weekly price momentum. And when it identifies the price trend momentum. It also activates the initial targets above the mean. And this very specifically tells you that sell one level is 1751 to 1777. So these levels are the levels that are at the extreme above the mean. The B1 of 1687 and B2 of 1648 is the extreme below the mean that will be activated if we close below 1712. So in this simple format, what you see, number one, is the average price of the reversion to the mean principle that we use, the extreme levels above the mean, and the extreme levels below the mean. And so within this structure, you can see the vortex mathematics that we use within the Fibonacci perfect sequence of 5 levels that we use. You see that a little more clearly when we take a look at the chart. You see the structure here of 5 levels, and it really doesn't matter whether you're doing daily, weekly, or monthly. We use a certain specific criteria that is a systematic way, basically, and methodical way of taking a look at the market and coming outside of the box, thinking outside of the box, so to speak, that it will entrap you if you follow the herd. The VCPMI is a contrarian indicator, and more than likely it would be telling you to buy the market when everybody's telling you to sell. You know, with the market at 1673 last week, we had a tremendous amount of bearishness and sentiment in the market. A lot of people giving up the gold market. Oh, it's over with the gold market. And the algorithm told us, look, we came into this very high probability area that is defined in blue. And the market will tell us. And by the market coming down here, testing this 1673 and reverting right back up above the daily, the weekly, but mainly I think what we saw here was the completion of the Fibonacci retracement that we use basically, which was 1685. 1685 is a 61.8% retracement, Fibonacci retracement, or what they call a golden ratio retracement, which is a pretty reliable indicator that we use as completion of retracements. You can see the reversion unfolding here in gold back up into that average price now that we have of 1717, 1712. And, here's the thing that we continue to adhere to and recommend and tell you that, we choose not to trade. We choose not to trade the average price, which is 50 standard deviation, because you can see here that the market can get pretty choppy here at these levels. So I step away from it, and I want to wait until the highest probability, whether it be below the mean, when the market, like, it came down to 1685, activated these levels here pretty much. But more than anything else, it begins to incorporate some of the other technical indicators that we watch, which complement the VCPMI. We use the VCPMI because it's a prospective view of the market in terms of giving you the highest probability levels that the market could revert, and not that it's 100% guaranteed when we talk about 90-95% probabilities. They are mathematical levels that we trade. They are probability levels mathematically that we trade, where it identifies the extreme levels above the average price for the supply and demand, basically, that is exchanged during the day, during the week, during the month, during the year, during the cyclical patterns that we use. It's all about exchanging the supply and demand. It's all about exchanging who is buying because they think the market's going up, or who's selling because they think the price is going to come down based on their own criteria that they use to analyze the market. Fundamentally, or otherwise, whatever they use. The VCPMI tells you when you're in the average price, just watch the market trade, and your highest probability trades will be identifying the extreme levels above or below the mean. In this case, you can see below the mean, it activated the buy trigger, now trading around the average price. Came down again to a buy level here that we're looking at about 1705. And the market held, came down very close to that 1705 level. 1705.60 was the low on the 10th, and reverted right back up above. $17.17, almost, as I said, to the target of $17.37. It completed the target on the 11th at $17.38. And this signal here, upon completion, it tells you you just go neutral again. And then you wait for the next signal. If it closes below, you go short. This is the short trigger. Automatically, it activates the target below, which is the mean. Completed. You go neutral. So here's another trade from 37 to 17. From 1:15 a.m. and 6:30 a.m. Yeah, so if you're trading Globex and if you're up, during that time, then obviously you can turn on your machine, your computer, and take a look at where the market is, and you can trade this 23 hours a day, basically, with Globex in the U.S. markets. So here, it's activated a bullish price trend momentum. And again, it activated the 1737 level from here. But again, we tell you, we choose not to trade. It's going to get very choppy, and we wait for the extreme above or below the mean. Market did not follow through to the upside, but instead came down below the two levels and closing below 1712 on the 11th at 10:30 p.m., which is when most of the signals seem to be activated. It gave us a target of the buy one and the buy two weekly level. I go back to reiterating that when the price comes down into the blue levels, starting with a B1, daily, weekly, and monthly, it recommends for you not to go short from these levels, because again, mathematical probability identifies the shorts only with a 10% probability that the market can come down. Even though there is still a 10% probability factor that the market can still come down, it recommends not to take that probability, but to wait for the highest probability, which is that if the price comes down upon failure, or what the AI tells you is you probably are going to identify buyers here when the signal is activated. And the market will do and confirm or negate. And here you have a struggle of buyers and sellers in this area until the buyers overtake all the supply that's being offered here, which is what the AI is telling you. That's the probability that the buyers down here have a higher probability to overtake the selling pressure, and then the signal is activated by closing above the trigger point and activating the signal. 1704. You waited for the next one, 1705.20, closed above it. Automatically, again, your protective level is the level below, and we give you three choices of stops: a catastrophe stop, a close below right away for conservative traders, or the end of the day, depending upon how you want to manage your risk. So here it activated a buy signal, and the targets above automatically are activated. So here the market completed the targets above daily, weekly, and even went up above the daily average price, activating a bullish price momentum with a target above of 1737 being activated. And we can see the price action moving into that level. And what we see here is that the market is beginning to experience selling resistance a lot sooner than 1737. 1733.10 is the high, and this is where we're beginning to get a reversion unfolding. And and we are just watching this. So we want to either let the market run up to 37 or come down to 17 and see how it reacts into this harmonic level of support, or averages, you might say, and then we can go from there. Let's take a look at the market here a little bit and see what it's doing here. For those that are long the market here in my following, if you my trading room is listening here, I would buy dust here and hedge and lock in some of these gains that if you made here, and you want to buy dust on a 1-to-1 ratio. Right now, I don't have time to be sending texts, so this message is directly intended for my trading room here in Discord, my private traders. You want to hedge with dust on a 1-to-1 ratio. We are look at the market, and we have a core position basically, and so I think what we're going to do for the time being is hedge a little bit here and buy in dust, which means that we could see a little bit of a pullback in gold here, and we want to cash in on these short-term swing that we could be looking at. We want to always protect the gains that we make and use the short-term swing gyrations basically to add to our long-term core position. Because the futures markets here are experiencing a tremendous amount of historic volatility that gives traders, day traders, particularly opportunities to cash in. A little bit of a pullback here in gold. And I think the silver is the one that actually initiated this short trigger. And we are in a bearish mode right now in silver as a day trade. One of the things that I want to comment here, first of all, the analysis that I've done today has been completely technical in its nature, in identifying the variable changing price momentum indicator primarily by using the structure that it offers for us to day trade, swing, or position trade. But if we take a look at the fundamental picture that we're looking at, it is building up a tremendously bullish fundamental picture. And the stimulus package that was approved is a tremendous package that I believe is going to give some people relief from some of this economic stress that they might be dealing with right now, and provide what I believe is a sense of confidence to the economy, to some of this Main Street people that are in tremendous need, small businesses, mom and pops, pretty much the whole industry, the whole sector, the whole economy is in need of stimulus. And it looks like the Feds have acted, particularly in March, very, very timely, because the market, in the stock market made the low. And we, since, we're trading at 39.20 that's about 1,000 points since last March. The gold market got up to 20.89. In what we've seen here is a consolidation phase in gold since the high of 20.89 was made. And grant you, it's been a very frustrating process, because this consolidation has come in on the face of what we're looking at to be potentially a major shortage of physicals. The gold market is beginning to see contango in the future prices, which means that the cash market is trading above the futures price. And when that happens, it basically is signaling that there is a shortage of supplies. And I see a few what could be possibly major challenges, major black swan developing in the financial markets, with a couple of different elements that I think are major elements to analyze. One of them is the supply. The availability of most products on a global scale seem to be scarce. We're having a problem obtaining initially vaccines. We're having a problem with obtaining, physical gold, silver. We have a shortage of microchips, producing microchips. And it appears that we are beginning to see a shortage potentially unfolding as we move back into the economy. And I think one of the instruments that are beginning to anticipate that potentially we could see this turn into some kind of an inflation spiral that could get out of control is the fact that the 10-year note interest rates are trading at 160.60. We've made a new high last week. And this is pretty much what I believe is the interest rate market, particularly on the 10-year note, which is primarily where most of the hegemony is located, is beginning to anticipate that interest rates are beginning to move up on the expectations that this could be igniting, that this stimulus could be igniting inflationary expectations as we move into the rest of the year. And we've came down to 1673, which was the low made last week. And this is a counterintuitive move that we have seen against tremendous world recognition that we are running out of supplies in silver. Reddit, Wall Street Bets, Wall Street Silver are making a major point of making the whole world aware that there is a potential shortage of silver beginning to unfold. And we're talking about silver as part of the monetary system. It's poor man's gold. And according to some of the fundamentals, we are pretty much running out of supply. I personally got quoted here about 1180 on gold over spot, in about $5.80 to $10 on silver slugs and silver gold eagles, which is about a 33 or 40% premium markup if you want to buy real money, which is really what silver is, and it's always been. The difference is that we're moving into a completely new paradigm, a whole completely new economic system that is highly dependent on technology, the climate changing, the green movement is putting in tremendous demand in the application of silver in industry, technology. And silver is being used more than the gold market, than the gold itself. Although gold is a very good metal that you can use in industry as well as medicine, and as well as pretty much as an electrical conduit. And so the application of these precious metals are beginning to be very specific, because industry is beginning to find shortage of materials to produce telephones, to produce solar panels, to produce microchips, to produce batteries. So we're beginning to see an inflationary spiral developing, which is of an inflationary nature. And once again, the anomaly that we find in the gold market is that how can silver and gold be trading, at 26.18 for silver, 1700 for gold, when we are running into a potential shortage? And this is the contrarian, basically, energy in the market, that the market will go when pretty much nobody wants it to, or when the sentiment is at the extreme level, optimistically or pessimistically. And the market is not going yet because there's so much optimism now. The whole world has looked into the price of gold, and you go to the internet and everybody's making out all these outrageous projections for gold, and there is major talk of shortage, squeeze, and you have the price of silver trading at 26.16. I think the $30 30.43 was a bleep, so to speak, that was caught by surprise on these short sellers here that are capping the price of silver, that are capping the price of metals, which are primarily central bankers that are trying to maintain a certain amount of integrity in still the US dollar as a fiat currency, but are losing control because all of this tremendous stimulus that we have that is coming into the market is not bullish for the US dollar as a currency. And when you get now the whole world to pay attention to what this a resource, this natural metal, this monetary unit that's been around for thousands of years, and always, whenever we've had monetary chaos, economic crisis, it's come into the picture as a way of protecting our the intrinsic value of our assets when the currency collapses and all the assets under that currency collapse. And that's what we are potentially doing in this country if we continue to provide more stimulus, more printing, more chipping away at the currency. In fact, the irony is that all these checks that are going out, the mere fact that you're getting a check from the government, when you deposit that check, the value of that deposit is going down daily because of the fact that the government is printing so much money for free. So it's a dilemma in terms of the economy needs that we have, which is that it needs liquidity, it needs stimulus in order not to implode into some kind of a deflationary spiral once again, which is the fear that most governments have around the world. So for the time being, let's forget about the consequences of printing money. Let's print as much as we need to. Let's buy every asset out there, from government bonds to ETFs, and provide almost what appears to be universal income, for people on a global scale. So pretty interesting times that we're dealing in right now. And we are going to see, I think, and hear a little more about where we're headed with regards to interest rates here as we come into this week here with the Federal Reserve meeting that we have here coming into, I believe, towards the later part of the week. Once again, ladies and gentlemen, thank you for the opportunity to share this information with you, and I really hope this is making a big difference for you. Thank you again. Please take care of yourself. I'll talk to you next time.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.